Hi, my name's Pat Papano, and I'm an author of a self-published book called Owning Main Street, Beginner's Guide to the Stock Market. And I wrote the book because many investors, like this gentleman you see pictured here, who I selected for the cover of my book, represents many Americans who feel that they may need the market, but really don't know how to access the market. They're intimidated, and they don't feel comfortable working with Wall Street firms. So for this reason, I wrote this book, which is a compendium on all the possible investment vehicles that one could use. But my real focus is on the common stocks of the great corporations. And the cover of the book, I have this gentleman pictured because there is a thicket on Wall Street. And the thicket is that Wall Street brokers need to get paid a commission in order to make a transaction. And the fact of the matter is you don't really need a lot of transactions. Once you buy a stock, you can hang on to it, and there are no more fees involved. And of course, you can't make a business out of that. So that's the genesis of this book. And the reason that I've selected this gentleman is that he may instinctively know that Wall Street is not the best way to get to where he wants to go, and he needs to assess this for himself. So, for a person or a family wishing to invest for the future, to perhaps provide a retirement for themselves, education for the kids, and so on, there needs to be some kind of a financial growth program in place. And as I've said, that the Wall Street represents a thicket through a gazillion products, all of them with carrying fees that may not necessarily get you where you need to go. However, you're always going to be vulnerable to appeals that just by investing in the common stocks of the great corporations that you're missing. For example, certain like private equity would be one example. And if you don't know what private equity is, you're then vulnerable to that appeal. So what we're going to do with the book, and hopefully in this presentation, is guide you through the thicket. And it's like taking a trip across America. There are many side roads which may even look very compelling as you go, but they're not going to take you where you want to go. So the purpose here is to put you on a route that will guide you through the thicket, keeping you off the side roads, and taking you from an origination to a destination that's going to work for you. But you actually don't have an option. The stock market is a requirement. It's the only way to grow wages. And wage growth typically is just a little bit ahead of inflation. And to call that wage growth is really a little bit of a red herring. It's not wage growth at all. We have an annual inflation rate, somewhere annualized around 3.5% per year. So if you get an annual raise of, let's say, 4%, it's not growth at all. You're just being, your wages are just being kept constant, reflecting the growth of inflation. So you have to be paid a little bit more to be paid the same buying power that you were paid in previous years. So putting savings to work, for example, a passbook savings account, will just keep those savings from wages growing at approximately the same rate as inflation, which is, for all practical purposes, no growth at all. It's just maintenance. What you want to do is put them in the market where your returns are going to be 9% or better. And it's in that growth rate, 5.5% or more ahead of inflation. That's where the solution lies to saving for retirement. Inflation has an annualized growth rate of somewhere between 3.5% and 4%. But as you can see from this chart here, that's not every year. Inflation can be somewhat volatile, and it's only an annualized inflation rate. But what the market does is the market will always stay ahead of inflation. That's why you want to be in the market. Now, the market itself is very volatile. If you look at this chart, you'll notice that the volatility is very great. It'll run from, let's say, minus 37% return some years, which would be losses, and even up 37% in some years. And sometimes those loss years and gain years are bunched together. So it's a very volatile ride. Now this happens to be the returns from the S&P 500, which is given a designation of a volatility value of 1. And all stocks are rated in volatility relative to the S&P 500. If stocks are more volatile than the S&P 500, they may be given a beta of, let's say, 1.5, 1.5. If they're less volatile than the S&P 500, they may be rated 0.5 or 0.75. But as you can see here, the S&P 500 is quite volatile. Okay, in addition to having prescriptions for investing, there are also prescriptions for disinvestment, good practices and bad practices. And in this chart here, you'll see two disinvestment streams modeled, a 7% disinvestment stream and a 10% disinvestment stream. And one would naturally think, well, gee, 10% is going to yield a greater income, so why don't I take 10% out? Of course, the opposing thought there is, if I take 10% out, will my money last long enough? Well, the point is that by taking out 7%, not only will your money last longer, but you will actually get a larger cash flow from that capitalization, as shown in this chart. A 7% withdrawal rate beats a 10% withdrawal rate in both the earnings or the income that it provides you, but also in the remaining capital you would have after, let's say, a 20 or 30 year period. Now you're probably wondering, how could that happen? How could I withdraw 7% and wind up with a larger income? Well, the reason for that is by withdrawing 7% instead of 10%, you're leaving that 3% in the market to grow. And as you can see, after a term of 10, 20, or 30 years, that difference in growth rate, just from that extra 3%, is dramatic. It's almost 3 times or twice. The withdrawal rate is something that you control, but there are market forces which you cannot control. And those forces can have a profound impact on the income that you're able to derive from those investments. As you can see from this chart, which models early declines and late and early gains, if you start out with working capital of, let's say, $100,000, and in the first year of the investment, the market goes down, let's say, 10%, and in the second year it goes down another 10%, what you have is it's almost like a starting capital of $80,000 instead of $100,000. So you've not only lost that capital, but you've lost the gains that capital could have realized if the market had gone up 5 or 10%. So in that, you will have a very difficult time recovering. In fact, you will never recover from those early losses. On the other hand, you see modeled a similar, and it's actually identical returns, but pretty much upside down, front-end loaded differently. And where you have early gains, you'll notice that your starting capital has gone up dramatically just in the first couple of years. And that's like putting a supercharger on your engine. So it brings you a dramatically better result. So what's the lesson from that? Not to invest, or not to invest because you think it's going to be a down year? No, the workaround for that is to invest frequently. So the way to manage market volatility is with very frequent monthly investments. And whether the market is going up or down, it really doesn't go up or down in a day or in a week or a month. It's a constant up and down movement. So the way you defeat volatility is you invest every month. All businesses go through a growth cycle. First of all, a business would start out by serving a market. And markets are not created. Markets are discovered by alert entrepreneurs. So they would discover a market, and then they would evaluate the market to see if there was a product that was complicated enough not to attract immediate competition, look that it would be long-lived, and if there is a market that could be served with a product like that with sufficient complexity and long life, then this attracts entrepreneurs who would spot the market, develop a product, and introduce that product into the market. Now at that point, at that stage in the product's life cycle, it's a question mark because you don't know if the product will succeed. It may be a great idea, but great ideas don't necessarily always succeed. So the first stage of a business is question mark. Now if the market that has been discovered and is now being served turns out to be quite a large and fast-growing market, and the original entrant is able to obtain supremacy in serving that market, then that entry will then become a star category. And what star category means a business that may have competitors, will almost always will have competitors, but is dominating in a fast-growing market. However, the company at this point is not profitable, even though it's dominating in a fast-growing market, because much of the money, much of the income that it earns has to be put back into marketing and product development to stay ahead of the competition. So this is not necessarily a winning game for investors, but it is a winning game for the company to survive. Now, if the company manages to dominate all its competitors, the competitors, after a while, a number of them will exit the market because it's just not paying off for them. And at that point, some of that money that had been directed to marketing and product development can now be redirected to investors. So that spinning off of cash flow in the form of dividends to investors would then qualify that company as a cash cow. And the cash cow would be probably the longest stage, and it could go on for many, many years. But eventually what will occur is that the market will no longer be well served by the product, that there'll be alternative product categories that will be coming in and poaching on that product's market because the product is aging, it's no longer serving the market optimally. And so at that point, the business then becomes what's called a dog, and it begins a gradual decline. It's still profitable at that point, but it's not growing as quickly, whereas a cash cow is growing at the rate of inflation or greater. A dog is typically not growing that fast, and ultimately it will go out. Now, most businesses start out as a question mark. Then if they succeed, they will enter star territory, and if they manage to dominate their market, then they become a cash cow, and after some period of time will then go into the very long and slow, or sometimes a faster decline as a dog. In the early stages, as we've mentioned, during the early growth stage, the question mark stage, the company doesn't know initially if it has a business, but as it engages that market, then it can determine that yes, this is a business, it's a fast-growing market, and they then pursue that. Of course, that takes a lot of money, and that means that the company is not profitable at first. They're only building a future cash flow. Then at some point, as the competitors leave the market and they're able to dominate the market, market dominance then allows the company to raise prices and realize greater profits. And it's only at that point that they begin to see daylight and realize their first profits. Then, of course, after that, profits will climb rapidly to a period of maturity. The company will then own a profitable maturity that could go on for quite some time, and then the gradual decline as the business matures and goes into decline. Some companies manage their businesses. They have a number of businesses. GE, for example, uses a matrix very similar to the one that you see here. And as you can see, just from the matrix that we just looked at with the stars, the cash cow, the stars, the question mark, the stars, the cash cow, and the dog, the upper left-hand corner of this are where they have market dominance in fast-growing markets that are taking a lot of money. Those businesses are growing. They throw money, marketing money, product development money at those businesses. At the other end, in the lower right-hand corner, you'll see that those are businesses that are in the dog territory, or maybe they're past the dog phase, and those businesses are being harvested and then sold off. Okay, this chart here is for Starbucks, and what you'll see is the performance of Starbucks stock from the time it was a question mark until, well, right up until today, where it's now borderline star to cash cow. I believe that they may have just begun to distribute dividends. Now in the this chart, you can see that there are two types of companies. There are companies that throw off cash in the form of dividends, and then there are other companies that are in the question mark or in the star stage, and there are no dividends because all of that money is being used to support the product. So in this graph you see here, you'll see a lower gray line, which is strictly stock price appreciation, and that's called the price return line. Then you'll see a blue line above that, and those are the dividends which these stocks are spinning off. Now this graph seems to be is the S&P 500, so many of the stocks don't provide dividends at all. So this is just a composite of what happened on the S&P 500. But what you'll see is that there is a dividend distribution on many of these stocks. So the lower gray line is stock price appreciation, and then the upper blue line is stock price appreciation plus dividend distribution. So the gray line we call the price return line, which is the appreciation of the stock price, and the blue line above it is the total return line, which would be stock price appreciation plus the dividends, giving you a total return. Okay, so we're looking here at the chart of a company going from the question mark stage to the star stage. And this happens to be Starbucks. And the way Starbucks got started is that Howard Schultz had two partners, and they were selling coffee. And Howard took a vacation to Italy, and while there he noticed that there were these coffee shops, espresso shops, just about on every corner in Italy, and that most Italians on their way to work just couldn't dream of even going to their work without stopping and getting a quick espresso on the way. So Howard thought, wow, you know, we don't have anything like this in the U.S. You know, I would think that an espresso bar would go over very, very well in the USA. So this is a case of an entrepreneur, Howard Schultz, spotting a market that no one else realized was there. Of course, he didn't know it was there either. So he returned to Portland or Washington State, to Seattle, wherever they were operating. He told his two partners about his idea to open up these espresso bars. And they didn't like the idea at all, so Howard then separated, took the name Starbucks with him, and started opening up coffee bars. And at that point, it was very much a question mark. His partners didn't think it would work, so they bailed out. But at any rate, Howard turned out to be right and discovered a very large and fast-growing market. So at any rate, he discovered this market, but then began growing the business. And at some point, Howard felt that the business had matured and he wanted to step out of it. So he left the business and he hired managers to run it. Now, up to that point, Howard had been managing this business as a growth business, as a star business, a business that required a lot of investment to keep it propped up and keep it growing. And the managers who came in then began a harvest strategy, and they started cutting back on quality and amenities and so on. So the business slumped. As you can see, there was a dramatic drop in stock price. Now, the stock price slumped about 70%, whereas the business revenue returns only slumped about 10%. And that's one of the differences between the underlying business fundamentals and stock price. At any rate, Howard saw this and he returned to the business, and he then turned the business around by refocusing it on valuing employees first and then valuing customers, bumping up the amenities, bumping up product development. So again, pursuing a growth strategy for Starbucks. And as you can see, the stock recovered. Now, there's a dramatic difference between a revenue drop of 10% and a stock price drop of 70%. You know, how can that be explained? And it can be explained because when you're valuing a business, and a market has been discovered, the market is there. That's not going away. There are people who want that premium coffee. They like the idea of being able to get what they think is a very good cup of coffee, being able to sit down, maybe read a paper at a Starbucks. They like to be seen there. People are very cognizant of the way they present themselves. And of course, the iconic Starbucks cup with that green logo is something that everybody recognizes as a person who appreciates good coffee. Maybe they're a little bit more stylish, this person. So that's the way people like to present themselves. So all of these factors then go to develop a very robust market that is there. What happened when Howard left was that the very same market just wasn't being served as well, but it was still there. So the business only declined about 10%, and the fundamentals of the business are that you have to pay rent on your space, you have to buy all the furnishings for the space, the coffee making machinery, you have to pay the employees, advertising, those iconic cups, that all has to be bought. So when you aggregate all of those costs, then you come up with a price for the coffee. That's what you have to sell the coffee at. You're not going to sell the coffee for less than what it costs to produce it. So of course, the coffee is going to be sold at a profit. And this gives the business structure. There will be, of course, increases and declines in the revenue, but they will be rather minor, like 10%, because the business was no longer being managed as a growth business. But stock price has a life of its own because there is no structured stock price. The lowest price that you can sell a stock at is zero. And a stock can go anywhere from $50 a share to 10 cents a share dramatically, in a matter of days or a week. So because there's no structure there, you can't say that a stock has any particular value. So stock price is very volatile, and revenue, actual performance of corporate return and the corporate profitability just doesn't vary that much from year to year. Now, this chart here shows you the interaction of supply and demand. Naturally, the higher the price for a product and the greater the profitability, the more people will want to supply it. So what happens is price goes up, so does supply. So as price goes up, so does supply. So you could say, in that case, supply follows price. But demand follows price as well. It's just that in the opposite direction. So as price goes up, demand dries up. Demand declines with high price because people want to buy something at the lowest possible price. So when something goes on sale, people flock to the store because now price has gone down, so demand goes up. So price regulates both supply and demand, but in opposite ways, opposition to each other. At some point they meet, and in this particular chart, they meet at $50. And what's happened here at $50 is that everybody who wants to buy this particular product at $50 exactly equals all of the suppliers who are willing to supply the product at $50. So in other words, in this particular chart, at $50, suppliers equal buyers or demanders, and so they reach an equilibrium point at $50. Now that we know that stock price is very volatile, how do you manage that volatility? And in fact, what you'll learn is that volatility is your friend. And the way you manage that volatility is with something that may have been discovered by the original Dow himself, dollar cost averaging. So as the market fluctuates up and down, one can pursue a strategy of deciding, well, what I'm going to do is I'm going to buy 10 shares of a particular stock every month. Or another person, person B, might say, I'm just going to buy $30 worth of a stock every month. I don't care whether the stock is up or down, it's always just $30. Now what will happen is that the person who's buying the fixed shares of stock, fixed number of shares, like 10 shares of stock every month, what they will be doing is they will be following the market up and down. They'll be buying 10 expensive shares when the shares are up, and they'll be buying 10 cheap shares when the shares are down, but only 10 all the time. So they are, in a sense, following the market, and then for them, volatility is not their friend. They would like to have very slow growth so that they're not ever greatly overpaying for their stock. Now, for dollar cost averaging people that are only buying a fixed dollar amount every month, that fixed dollar amount acts like a screen against volatility. So what happens is, in that case, as the market goes up, they say, oh no, I'm not going to buy a bunch of those expensive shares. So by limiting a dollar amount, they will only buy a few expensive shares. Then when the market goes down, they're going to say, oh wow, I'm going to buy a bunch of those cheap shares by just using the same dollar amount. So using dollar cost averaging, then, volatility becomes your friend. And as you can see from this chart here, comparing the results over 3 periods, a kind of a middle price period, a high price period, and a low price period, that the average share of a stock for the people who invested by the shares, whether it's 10 shares a month, was about $40 a share. That's the cost basis. For the dollar cost averaging, the average share cost is about half that. So here you have a much more profitable investment strategy using just simply dollar cost averaging. What we'll see here is that gradually uptrending line, and you have to wonder to yourself, well gee, if I bought into the Dow and I just held on, how could you not help but make money in that? And so one could say, wow, that's nothing but a money-making engine. But that's not correct, because it's very easy to lose money in that. And if you look at all the dips, you'll see that what will happen is that people will panic, they'll lose faith in the growth of America, and they'll sell off their shares. And that's how they lose in a winning market. And believe me, most of Wall Street, including the professionals, will frequently trade out of positions, and they will lose. That's the only way to lose money in the stock market, is to sell your stocks. Now in this chart here, just to make this point, you'll notice that some purchases, 6 purchases have been made, but they have been made at the worst possible time, at market highs. And what you always want to do is buy at market lows. But in this particular chart, what we're illustrating are those investors who have purchased at market highs. Yet even those investors who have made the worst possible purchasing decisions are in the end going to be turning out okay, because you can just follow the trace of the upward line as it goes up at a rate which is much greater than the rate of inflation. So buying even at the worst time in the market is a winning strategy as long as you hold on to your shares. Okay, but what you'll want to do is that you'll want to pick stocks that are going to be in the business long enough to take advantage of this general market behavior. And what I have here is a chart of the Dow 30. And you can see the longevity of these companies. GE was added to the Dow in 1907. 3M Company was added in 1976. And Procter & Gamble was added in 1932. So these are companies that aren't going away anytime soon, and they make very promising investment candidates. Okay, however, perhaps another way to pick companies is to look at the brands, look at the great brands of the world. And here you see a chart of, I believe that these are the 40 top global brands. And the reason that's important is that companies sometimes get all caught up in their products and consideration of their products, and they forget that they're in the business of building their brand. So what will happen, for example, is that companies will sometimes lose sight of the larger objective, which is to build the company profitability, and they'll get all caught up in perhaps in defending a particular product, which maybe is in the dog stage and is going out. You don't want a company that's going to follow its business cycle of a particular business, you know, coming in as a question mark, a star, a cash cow, and then going out as a dog. What you want is a company that understands that they're in the brand business. They're not in the cola business or in the car business or in the electronic appliance business. They're in the brand business. And so everything they do with an eye towards building their brand, because it is by the brand that they make their profit. People always gravitate towards the top brands, and they're happy to pay more money to get a product from the top brand to assure themselves quality. So building the brand is central to operating a business. Not all companies understand that, but this is a chart of 40 companies that do, and they make excellent investment candidates. Okay, another way to select stock are dividend payers. As we've mentioned before, companies that are in the cash cow and dog stage will be profitable because they don't have to defend their positions, so they will spin off dividends. And some investors place very great importance on dividends, retirees particularly, because what they want to do is they know that the dividends are not capital. The dividends is the money that capital produces. It's like a savings account. If you put $10,000 into a savings account, it's going to produce maybe $500 a year in interest, and you can take that away without disturbing your capital. And that's what dividends are. It's the money which your money is producing annually. So retirees particularly like dividend-paying companies, and they like to, if they can, live only on the dividends. So that's one way to select companies. Now in this next chart, you'll have companies that really focus very heavily on their dividends, but they're not all regular companies. The companies of the Dow 30 and the S&P 500 are what are called C corporations. That's the standard legal framework for a corporation, which will have a chairman of the board, a board of directors, and a chief executive officer, and various other officers. That's a C corporation, and most corporations are C corporations. But there are other companies that get together which are partnerships, and their idea is that they're in a very, very mature business, all of it in the cash cow business, which isn't going away anytime soon. And because there's no real growth component to it, the C corporation business structure is not optimal. That's more optimal for growing businesses and for managing multiple businesses. But when you have a very mature cash cow product that isn't changing much, partnership structure, business structure, it may be more appropriate there. And they spin off the very large dividends. And as you can see here, we have some C corporations here, which are Verizon, the telecom. They spin off pretty good dividends. Then power generation utilities are C corporations. And then you have some partnerships, which are going to be pipelines, real estate investment trusts, and tankers. There's some tankers here that are throwing off tremendous dividends, 10, 11%. Then you have tobacco. Now, we don't necessarily want to promote tobacco, but just point out that tobacco stocks have historically been very good because it's a very, very slow changing market. It's only adding new smokers. Once people start smoking, it's very difficult for them to quit. So that makes a good business. Unfortunately, tobacco happens to be one of those businesses for that reason. Okay, so now that we've looked at a number of options for selecting stocks, what you'll want to do is you'll want to select and make a portfolio of stocks. And what I show here is a 4-stock portfolio. ExxonMobil, McDonald's, Procter & Gamble, and Amazon. That's a 4-stock portfolio. Now, and they're very different companies. First of all, ExxonMobil is a global energy provider which involves both exploration and refining. They are a leading supplier in a commodity which everybody has to have. Even in the worst of times, people will have to buy fuels. And ExxonMobil is, of course, a leader in exploration and in refining, and a leader in a huge industry. So it's a very, very solid component for any portfolio. Secondly, McDonald's. McDonald's is very different from ExxonMobil in that it's in the food business, but like ExxonMobil, it's in a commodity business. People just have to have McDonald's at some point in their lives. Many people eat there every day. They might have breakfast there. They might have lunch there. So McDonald's has a very, very solid market, and like ExxonMobil, they dominate in that market. ExxonMobil does have some close competitors, Royal Dutch Shell being one, but McDonald's doesn't. The nearest competitors are actually no match for McDonald's. So it's a very, very solid company in a commodity business, a staple that people will patronize. I happen to have been in China some time back, and McDonald's is very popular over there. And I recall that from about 10 o'clock in the morning till about 3 o'clock in the afternoon, you couldn't even get a seat at any of the McDonald's. They were just 100% capacity all the time. And this is China, which has 4 times the U.S. population. And McDonald's was in 119 countries last time I looked. So it's a very, very solid, very well diversified stock, and also a very responsive company, very quick to employ new methods and change their menu if they have to. So you could say that McDonald's is a company that's very focused on their brand. Okay, the third company there is actually the king of companies. That's Procter & Gamble. Now, Procter & Gamble is very different than ExxonMobil and McDonald's in that they're very widely diversified by product. McDonald's is just breakfast, lunch, and dinner, and only food, whereas Procter & Gamble has a gazillion products in their product portfolio. And that's a case of a company that's managing many, many businesses all the time, starting new businesses all the time, selling off businesses all the time. So if I were going to be invested in only one stock, it would be Procter & Gamble. It also happens to be well known as one of the best managed companies in the United States. Now, all of these companies that I've mentioned, which is ExxonMobil, McDonald's, and Procter & Gamble, those are all in the cash cow stage. They may have multiple businesses, as Procter & Gamble's does, but majority they are in the cash cow stage of their business evolution, and they all pay dividends about 3.30%, 2.2%. But then what we wanted to do to this portfolio is to add a growth component, and that growth component was added by adding Amazon. And Amazon is in the star stage of their business development. Now, when you talk about diversity, one cannot have any greater diversity than Amazon. So what business are they in? They're in every business. There's not a very, very few businesses that Amazon is not in. So we think of Procter & Gamble as being very widely diversified, maybe 100 different products, 80 different products. Amazon, they're in thousands of products. So very, very well diversified company. And the manager, the owner of the company, or the CEO of the company and the founder of the company, Jeff Bezos, he has an objective, and the objective is he wants to sell everything. So this company have a very, very robust cash flow, but all of that cash flow is then going back into product development, into marketing, and so there's no dividend spin-off from Amazon because it's still in the growth stage. But looking at these four stocks, I would presume that the biggest earner for an investor is going to be Amazon. But it won't be, the total return will be strictly price return. There'll be no dividends from Amazon. Okay, now, if you were to mention this to a Wall Street actor, for example, you might get a call from a broker and say, well, how are you invested? And you might say, well, I'm invested in four stocks. I have ExxonMobil, I have McDonald's, Procter & Gamble, and Amazon. And that broker will say, oh, well, that's very dangerous to have only four stocks. You know, what if one of those stocks went out? You'd be down 25%. If two of them went out, you'd be down 50%. Your retirement would be shot. No, that's very dangerous. Well, conceptually, that's true. There's no structural reason why ExxonMobil can't go out of business, and the same with McDonald's or Procter & Gamble or Amazon. But the likelihood of that happening is very low. So in the meantime, the Wall Street narrative would be to pump up the scare factor that these companies could go out of business and then sell you on the idea of getting into a mutual fund, which they might have hundreds of stocks in those, and they're trading in and out of those daily basis. And of course, your returns from such a strategy would be quite muted. But the issue of diversity remains. Now, the reason that one wants to be diversified is if there is market upset and there's a drop in the market, if you're invested in only a very few stocks, then what happens is all of those stocks would presumably drop with the market, and you would have no cash available. You wouldn't be in a liquid position in any of your stocks. So the idea of Wall Street's idea by being, let's say, a mutual fund is if you have 100 stocks or 300 stocks, some of those are bound to be in positive territory, allowing you to have a little bit of liquidity even in market downturns. Well, this is a red herring. This is not necessarily the best way to obtain that kind of diversity. If, on the other hand, you diversify by time, and looking at this chart, I'm proposing GE. Let's say that you had accumulated shares of GE for, let's say, 30 years. So you had monthly purchases of GE stock over a 30-year period. You would then have stocks that have cost basis going back 30 years. So if the market dropped, and even if GE dropped, not all of the GE shares that you have would be underwater. You would still have liquidity because you've diversified not by position, but by time. So time is really a much better diversifier than position. Okay, now, how does one acquire so many shares over a period of time? We alluded to earlier to dollar cost averaging. Dollar cost averaging means making fixed dollar amount purchases monthly. Now this doesn't work on Wall Street because a typical trade would be $30 per trade. To spend $30 a month to buy $30 worth of stock would be ludicrous. One wouldn't do that. So you will not hear dollar cost averaging very much on Wall Street, except in relation to mutual funds for which there are no transaction costs, typically. But at any rate, what you can do is get a DRIP program. And DRIP programs are where an entity will actually come in and periodically every month debit your checking account and buy stock for you. There are a number of companies and they're all listed on the S&P 500, the Dow 30, the New York Stock Exchanges, and the NASDAQ exchange and every other exchange. But some companies, a subset, and it's about 1,000 out of 9,000 companies, offer what's called a direct investment plan, where you don't have to go to Wall Street to buy stock in the company. You can buy stock directly. Some companies manage their direct investment programs or DRIP programs themselves, but many rely on transfer agents to do this for them. But whether it's by transfer agent or if the company's running the program themselves, they will debit your account as little as $25 a month automatically. They will purchase stock for you, typically for free. There are absolutely no transaction costs. And automatic free dividend reinvestment. As the dividends are distributed, they will automatically purchase additional shares of stock for you with those dividends. So it's often called a dividend reinvestment plan. That's where the DRIP comes from. So if the company that you're interested in doesn't offer to manage it themselves, then they typically would have a transfer agent. Now, of the companies that we had on our 4-stock portfolio, ExxonMobil has a direct investment plan. McDonald's has a direct investment plan. And Procter & Gamble, I believe, has one. They did it one time. I believe they still do. And Amazon does not. But those 3 plans are available through, as you can see in the DRIP program, there's some transfer agents noted here. Wells Fargo is one. Computer Shares is by far, seems to have the lion's share of that business. So you can just go to the Computer Share website and you'll see that you'll have a very broad selection of DRIP programs available there. And in some cases, there are going to be some companies that not only allow you to buy their stock for free, sometimes you can buy it at a discount. Okay, now for Amazon, which does not have a direct stock program, so it's not available through Computer Share or any other transfer agent, there is a company named Capital One Share Builder, which you see here, and they have a DRIP program, automatic investment program, and every share purchase, I believe, is $3.95 a trade, so that's very manageable to have monthly trades and to one or other of these 4 stocks at $3.95 a month. They will purchase those for you, and I believe that they offer free dividend reinvestment as well. So that's another option for those companies that don't have DRIP programs themselves. You can turn to ShareBuilder. Okay, we have, through this presentation, guided you through what I call the Wall Street thicket, through the weeds. And what happens is that as soon as you go in and meet with somebody at a Wall Street firm, with a broker, you'll be offered a gazillion products. You'll be made promises that one or more of these products are going to make you rich, and all you have to do is open up an account with them, and that's the starting point of your road to wealth. And of course, this is going to be very bewildering because you're not going to understand the various products that they're being offered. It's not intended that you will understand, that you only trust your broker to make those selections for you. And that's the thicket, and that's one of the reasons it's a thicket, is it's bewildering. You don't understand what the product is, how it works, and you have absolutely no idea what its track record is. So what we've tried to do here in this presentation is to show you a path through the thicket, that we understand that there's a thicket there, and that some of those paths running off to the side may sound very alluring, but they're not. If you're interested in developing some level of certainty with being able to provide for yourself, for your future, for retirement, there's only one way to do it, and that's with the stock market. And the most certain way to succeed in the stock market are with those companies that have been in business, over 100 years. GE going back to 1907. These companies are going to be around for a while. They provide a very nice annual return, and more than enough return to provide a retirement for yourself. So don't listen to the Wall Street siren song. Don't listen to these promises of great wealth through the thicket here. Ignore the thicket. Just stick to your route through the weeds, through the thicket, and invest in the great corporations, great global corporations, and they will provide you with the kind of retirement that you need. And if you allocate 5% of your earnings to a dollar cost averaging program into the 3 or 4 or 5 of the great global corporations of the world, that's where your retirement will come from, almost certainly. Then here's a copy of my book, and that book will also show you through the thicket. This book, however, is a compendium. It will discuss almost every single investment vehicle that there is, only for the purpose of arming you against them. I have a new book coming out called The Younger Mouse Gets the Cheese, which focuses only, as this presentation has, on the best road to take, which is the dollar cost averaging yourself into the greatest global corporations. Thank you very much.